Hello, this is Victor Cuevas with Victor for Advice. Let me adjust this camera a little bit. And today I'm going to do a case study using an index universal life for a tax-free retirement. I'm not going to be talking about whole life versus IUL and the ins and outs of that. This is strictly someone who's 35 years old and wants to set up a tax-free retirement that later on in life is going to pay them a lifetime income tax free. I'm going to show you a case study there, and I'm going to show you the price structure in there. A lot of people are afraid to talk about the cost and the fees inside of an IUL. Nothing bad about that. I'll show you how that works. I'll compare it to if you decided to go with a 401k or an IRA. And would that be better than an IUL? And it would not, and I'll show you that clearly. So you can get a good understanding of how an IUL can be very beneficial for someone if they want to use as a retirement plan, or what we call a LIRP, a life insurance retirement plan. So stick with me on this. Okay, let me put my eyeballs on here. And here I'm using the insurance company Allianz. Reason I'm using them is because they're very good. I like their product. The indexes are fantastic and have very good crediting long term, and the price structure is good, and the flexibility is very good. So, all in all, and there are some things about the Allianz product that is not available anywhere else, and I'll touch on that. So, what do we have here? I've got a 35-year-old, and what I'm using for a death, or I'm using the setting this thing up, as you can see, with a minimum face maximum accumulation. What that means is we want to get as small as death benefit as we possibly can, and we want to be able to cram in as much cash as we possibly can for the amount of money that's available, and that will make it run as efficiently as possible. In order to do that on this death benefit option, I put a B with it, which is an increasing death benefit. There are some agents out there that will use a level or an A uh, death benefit option. It jacks up the death benefit. It increases dramatically the commission. I generally don't like that way of doing things. Sometimes, depending on what the individual wants to accomplish, especially if they want to start out with a lower amount of death benefit and cram in a bunch of not death benefit, but premium, and then want to increase that premium dramatically, you can use that type of death benefit option. I still don't like it. I'd rather just open up another policy later on. But we're using the more efficient way of doing things, which is a level death benefit, and we're going to be contributing into this policy for 30 years. He's 35. At 65, we're going to stop contribution. At 66, start drawing lifetime income. So at that point, after 30 years, we're going to level this death benefit out. Again, designed to keep the costs down as much as possible. We're putting in $12,000 a year for 30 years, and then nothing after that. We're going to be drawing income. I put income here, starting in year 31 and going through max. So when I come over here to this panel, I can see that my initial death benefit is only 227. If I went as a level death benefit to begin with, it'd probably be 700 and something thousand dollars of death benefit. Massive difference. But I got 227,569 here. You can see that the minimum premium that he can put into the policy is 3470. I would recommend that. If you're going to drop it way down from the 12,000, you would want to go any less than the target premium of 4,083. We can see that the max non-MEC premium is 14,454. So the client could go from 12,000 up to 14,000 in a year and still not make it at what we call a modified endowment contract, which would mean that the policy would lose its tax-free benefits. We definitely don't want that to happen. So that's the way it's set up. When we talk about max funding, you're looking at this 3,000, 4,000 mark, but he's putting in 12,000. So you can see that most of the cash going into the policy is really going to build up that cash value and not so much going into the cost of the policy, although obviously there's cost involved. Now we're going to go to this other panel and look at the spreadsheet. So here's the spreadsheet, and we see the death benefit here. And we see these other numbers that we were looking at in the side panel. And we see the 12,000 a year going into the policy for 30 years. Now we see 12,000 the first year, and we have an accumulation value of 10,476 the first year. Now, this illustration is based on the policy returning 6.1% a year every year. Well, obviously the policy isn't going to do that. There are years it's going to do a lot better. There's years that you could have a zero return that year. This particular insurance company, Allianz, has a lock-in feature with 3 of their indexes. No other insurance company offers that, which means that any time during that 12-month period that you're waiting for interest to come in, you can lock in your gains. So if the index is up 12, 15, 20 or more, because you can get some massive index returns in any given year with this policy. I suppose it's up 20% that year. You like it. You don't want to risk losing that. You lock it in. That way, if the index drops to 8% by the end of the 12-month period, you're going to keep that 20% return. If it goes up to 25% at the end of the year, you're still just going to get the 20. But this feature, which is again found in no other insurance company, allows you to have the opportunity to have no zeros in any given year. Even if it was up to 10% and it's dropping, and you get scared, let me lock it in. You lock it in at 3%. At least you got 3% that year. So instead of a goose egg. That's very powerful because you can really have the opportunity to really outdo the illustration. Also, I will say that because of the insurance commissioner regulations out there, we can only illustrate 6.1%, whereas the indexes that I'm using in this one are averaging over 8% a year. So I can go ahead and just say that the opportunity to have better response returns than you see here is along with the lock-in feature is a pretty much a good bet that you can even beat what you're seeing right here. But we're just using the 6.1% and it still works out pretty darn good. So you see that the charges in the first few years are kind of high. It's like a mortgage, it's front loaded, and the fees do get better. I know that you hear fees get higher and higher and higher as time goes by. Well, if the policy never returned anything, that would be the case, but it is tied to stock market index. And the stock market isn't going to go 5, 10, 15 years and never do anything. So let's face it, this policy will have returns in it and it will have cash value accumulation. The cost in effect will be lower as that cash accumulation increases. But you see here, the first year, you put in 12,000, you have 10,476,000 in cash value. You can tell right off the bat that that's a very efficient running policy right out of the gate. Now you have this column is cash value. It's really cash surrender value, which means that if you, at the end of 12 months, and you've got this return where you end up with 10,476 in accumulation value, and you decide, you know what, I don't want this anymore, you terminate the policy, you're going to walk with 2313. That's it. That wouldn't be a smart thing to do, but that's what this means. Also, this is the amount that you can borrow from. You can't borrow from the true cash value. You can only borrow from the surrender value or the cash value here, because the insurance company wants to safeguard themselves in these first few years so that if someone terminates the policy, they won't lose money on the expense they incurred in putting this policy in force. So you see right here that we listed the charges of this policy. Now, in a whole life policy, they won't tell you what the charges are. You'll never see what the charge, you have no idea what the total charges are in a whole life policy. You know there's charges in it because if you terminate the policy the first year, you're not going to walk away with all the money you put into it. We can tell by the internal rate of return that there's uh, fees in that thing and charges, but we have no idea what they are. Well, with Index Universal Life, you know exactly what the charges are to the dollar. So we see them right here and we see the interest that's coming in. Another good thing to note about this is in year 5, you put in $60,000. 5 times 12 is 60,000. You have over here 60,279. So you've broken even in the 5th year. Another good sign that this is a very efficient policy. Most whole life policies, if you have a very well designed one, it'll break even in the 5th year most of the time. Most whole life policies that some of these agents have won't break even for 8 years. But if you have a whole life policy that breaks even in 5 years, 5 to 7, it's pretty decent. Here you have a break even of year 5. By year 5, your cash surrender value is 52,774. That's what you can borrow from. That's what we call your bank. So at that point, you have some substantial amount of money you can actually borrow from for anything you want. So let's get down to year 10. And at this point, you have $145,000 in the policy. Now remember, this is based on 6.1% every year. You could end up with more than this. You could have 160,000. You could have 125 or 130,000 in here. But with this insurance policy, again, with this company, we're looking actually at a illustration that is illustrating far below what the index actually has returned over the last 15 years or so. Some illustrations you're looking at, they're actually using an illustrated rate that's the same or more than what the index is actually returning. So you don't want to consider that. So we're in a strong situation with this particular insurance company. But let's look at the fee structure. You're at $1,771 in here. Now you see it dropped from year 10 to from year 9 to year 11. So now let's look at that very quickly. And let's delve in a little bit into these fees. So you're at 1,771 total fees for the year, all in, divided by cash value of 145,452. So now we're at 1.2% fees. Well, let's look at that. That's what a decent managed mutual fund would charge you. Not an index mutual fund, a managed mutual fund, which are most of the funds in your 401k or IRA. Plus, the 401k has its fees on top of that. If you go to a financial advisor, like I used to be a fiduciary, he's going to charge you about 1.5% to 2% just to work with him. That's his fee. Comes out of your account. Plus, he puts the money with a third party guy who's going to hit you up for another 1%. So you're at 2.5 to 3% fees. So when you're looking at 1.2%, very reasonable. And it's just in year 10. Okay. And then you have 141,000 that's available to this thing. The cash value and the accumulation value even up after 12 years. Let's take it to year 15. The client is now 50 years old, from 35 to 50. You're sitting on, let's look at this again, 1773 divided by 267, 513. Now you're looking at 0.66, little over 0.5%. Big drop. That's a 50% drop in fees in just 5 years. But look at what happens over here in year 16. Drops down to 867. Well, let's look at that. 867 divided by 298, 245. Now you're looking at 0.29%, not even a third of a percent. You're in year 15 of this policy, and total cost is less than 1/3 of a percent. That's a Vanguard index mutual fund. That's cheap. You're in the policy for 15 years, and that's how cheap it gets. So you hear people saying out there, well, you put your money in an index universal life, and it keeps getting more and more and more expensive every year. It would be the case if it never made a dime of cash value. Well, we know that's not going to happen. It's going to make cash value. It's going to generate interest based on the stock market index. So as the cash value grows and grows and grows, those fees get smaller and smaller and smaller. And here you see it. You don't know that in a whole life. You know what? I guarantee you the whole life isn't going to be less than a third of a percent in year 15. No way. Not going to happen. So it's cheap. So we keep going down to year, well, let's just take it all the way down to year 30. It's getting ready to retire, right? Its fees are $1,895 for the year. Victor, it went back up. Yeah, sure it did. Cash death benefit is way up, but so is the cash value. So if I go 1895 divided by 1,033,494, the cost is 0.18. That's not even worth mentioning it. 0.18%. In other words, you have $1 million, and if that index returned a zero for that year, the only thing that will come out of your account is $1,895. That doesn't even put a dent in it. Not even worth mentioning it. But again, you'll hear people say, my goodness, when you get to in your 60s, the cost of an IUL is going to be through the roof and it's going to lapse. They don't know what they're talking about. Don't know what they're talking about. Okay, now we start taking money out. $88,838 is the most you should take out of this policy. Now, the way I designed it, I said take income for max. And I don't care if the guy lives to 120 years old. He's going to get that 88,000. You'll see a lot of guys, especially, folks, listen to me, especially in the whole life world. They'll say, all right, 35-year-old, $12,000 a year to 65, 30 years, and taking out income for the next 25 years. And look what he gets. That's bogus. Bogus. What happens if he lives more than 25 years in retirement? Let's see, 65, 75, 85, 90. Suppose he lives to 95. Well, now he's getting no income from that policy. Yeah, I could boost up that income if I said take it for 25 years. Yeah, to boost it way up. But I plan to live to 100 myself unless Jesus comes back here in the next few years, which I think he is. But anyway, you want to design this thing so it can last forever. Now, at the client, I don't know where the client will be. This particular client that I'm thinking about, it's going to be probably going to be a multi-millionaire by the time he reaches his 60s. He may not even need to take income out of it. He could wait for another 10, 15 years to take income. This thing could be well into the six figures by then. Would be well into the six figures by then. He don't even have to. He might just take 25,000 a year and let the rest go. It's up to him, but it's there. So you keep taking income out of this thing. What happens with an index universal life is that, which is so much better than having a 401k, is that when this $88,000 does not come out of your cash value. The insurance company lends you that money and leaves all your cash value alone to make whatever interest it can generate. Why is that significant? Well, if you happen to have $1 million in a 401k when you retire and you took no more than 4%, that would be irresponsible because you would run out of money. A lot of the financial advisors are saying now 3 and 3.25%. Can you imagine having $1 million and only taking out 35,000 a year or 40? Most people wouldn't want to do that. But if you take 40,000 out, you're still getting 2.5% out of that account coming out. So let's look at that. If you've got 1,033,494 times 2.5%, listen to me, you're taking $40,000 out because that's the most income you should take, 4%. But an additional $25,837 is coming out in fees. It's getting close to what you took out in income. It's what's coming out in fees. So now you're at what? 40, 50, 65, $66,000 just came out of your account. Well, what if it goes down 10%? You just lost another 100 grand. Now you've got 160 something thousand just come out of your account in 1 year with just a 10% loss. That's, do you want to retire that way? I'd put someone in an annuity all day long before I let them do that. That's crazy. That's how people are retiring. Here, Mr. Financial Advisor, here's my $1 million. Manage it for me. Sock me with those fees. When I take my 4% out, and the market goes down 10, 20%, because you know what? It's going to go down. And that, I tell you what, trust me, that financial advisor will not stop it. It will go down. Here, nothing is coming out of the cash value. The insurance company lends you the money. Why? Because they know this thing is going to continue to grow. They know they can do this for you. You won't have to pay the loan back. You won't have to pay any interest on it. They'll continue to accrue. And we can go down here and you can be 80 years old, still taking that money out. And guess what? You got $2.6 million sitting in cash value. Only $2,909 in fees out of a $2.6 million account. If you die, you leave $816,322 as a tax-free death benefit. What if you had died at 80 with a 401k and happened to have 816,000 in there? What would happen? It would go to your heirs and they will be fully taxed on that money. So you might as well knock off 30% out of that. And if their heirs are making good money, and that really bumps up to the highest tax bracket, they'll lose 40%, just the federal. Or what, 38, 36? Tax-free income is the only way to go, folks. and not having your money in the market in retirement taking income. That's not the way to go either. So we keep going, and look, by the time you get to 95, you don't pay any fees anymore except for 90 bucks. 90 bucks a year for the rest of your life, as long as you live. That's pretty good. Cash value, it just keeps paying. I don't care how long you're going to get that income. So, I mean, you could decide to start at, maybe I'll start at 50 and every year give yourself a little bit of a pay raise. That'll be more cash accumulation. Who knows? By the time you get to 100, this thing could be, you might be able to take out $110,000 a year, $120,000 a year. Do it any way you want. You have flexibility in that respect. So now let's see how this compares to what everybody else is doing. Not everybody else, but what most people are doing. So I'm going to come over here to your retirement calculator. And I've got years to accumulate 30. And I've got initial investment, nothing, starting out with nothing. And I'm being very generous here, folks. I'm fudging the numbers for putting your money in the market. I'm giving the Index Universal Life an unfair advantage here, or actually putting in a stock market an unfair advantage over the IUL. I'm giving it 7% compounding interest. We know that the stock market doesn't do compounding interest, but when you go to a financial advisor and he's looking at different funds, he said, well, this fund has averaged 6.5% a year, 7% a year. It's been doing that for the last 6 or 7 years, so it's a good fund to go with. Well, it hasn't done 7.5% every year. That was the average. The average is not compute to what is in the cash value of that investment. You could have averaged 7.5%, and gone from 100,000 to it won't add up to 7.5% a year just because it averaged that much. It's what you really have left after that 7 years. But this is the only way that you can do it. And all the financial advisors use a calculator and said 7% return, compounding interest, when that's not really the case. So we have an unfair advantage here. $12,000 a year per year, compounding annually, you see here. That would leave you with $1,133,000 and some change. If you pay tax along the way, it'd be $788,000. So there's your tax deferral is good. But when you're in a 401k, the tax deferral means you're going to have to pay taxes in the future. With an Index Universal Life, it means that you get the tax deferral, but you never have to pay the taxes. So we come over here and we have $1.1 million and some change. So if we use conventional financial planning, they would say no more than 4%. Tops. That's an income of $45,341 before tax. You take state and federal tax, lose 20%, minus 20%. Now you're at $36,272. You're sitting on $1.1 million in your account, and you know what you get your retirement income is? $36,000 a year after taxes. Then you throw your Social Security on there. Boy, you thought you were a millionaire, huh? Okay. If we go back to the spreadsheet, remember the income? $88,838, tax free. The cash value? Less. Why? Because this is at 6.1%. The other one was at 7%. This, folks, listen to me. Look, right here, you got to listen to me super, super carefully. This right here is net of fees. See all these fees have been taken out? This is what the account value is after fees have all come out. The other example I showed you and the calculator There was no fees. So I showed $1.1 million, no fees. Now we know there's been fees. I wish they would have something in that calculator and let me plug in 2.5% fee and see what that cash value would have been. Not as much as this. Do you see the unfair advantage that I've given putting your money in an IRA or 401k over putting your money in an IUL? Net of fees, $1.3 million. The other one was no fees ever taken out, ever. And you still end up with 88,000, 36,000. That's a no-brainer. I would debate this and put this against any retirement plan out there. I'll debate head to head all day long and answer any questions they may have on this scenario. Because I've been in both worlds. I've been in the securities world. I walked away from it's a crooked, it's a don't get me going on the securities world. It's a messed up world. Okay, they want to say insurance world is messed up. The securities world is way messed up. What they're doing to people in the securities world. I'll put this against any securities account all day long. And get this. Let's suppose you get to retirement and you die. You've got 1,033 in there, but guess what you leave your family? You leave 1.2 million to your family. Tax free. With the other one, you've put in money all your life. You're 65 years old. You're going to retire. You say you got $1.1 million and you die from a stroke right there. What does your family get? Not 1.1 million. Taxes coming out. Now, if your wife survives you, she can inherit that account, take it over. But she's still going to have to pay taxes here. And one day she's going to die and she's going to leave what's left out of that account and it's going to get taxed like crazy. Whereas here, if the husband dies, wife gets 1.2 million. Tax free. Cash. I mean cash. She can't liquidate if the husband dies and leaves her 1.1 million in the 401k, she can't liquidate that money. She can't cash it out. She would get nailed 40% if she liquidated that account. 40% state and federal minimum. Whereas with the life insurance policy, she gets 1.2 million cash. Cash right there on Barrelhead, right into the bank. She can decide, well, you know what? I'll take that money. I'll pay off all my debt. I'll pay off the house, and then I'll live off the rest of it. Do whatever she wants to with it. See, as you can see, in every conceivable way, the index universal life beats putting your money in an IRA or a 401k. Now, if you have an unbelievable 401k at work that has tiny fees, which there's no such thing, but let's say they're 1.5% total fees, and you have a massive, massive match, like 50% on 10% of your income or something. Okay, but see if they have a Roth 401k. You don't want that to be taxed. But do not max it out. Do not max it out. Go up to the match, stop it, and put the rest in an index universal life. But for many people out there, your 401k no longer matches. Total waste of money to put money. Total 100% waste of money to put money in a 401k at work if there's no match. Not a smart thing to do. You would just put everything into this or just open a Roth IRA. Or if your company has a Roth 401k, okay, put it in there. But don't put it in a taxable account. Okay, maybe one disadvantage is With a 401k, if you put money in there for 5 years and then can't put in money anymore in there, then you can go 2, 3, 4 years and not putting money in there. It's no big deal. With a life insurance policy, if you put money for 4 or 5 years and you decide you can't put money in there for the next 5 years, that could be a problem. But it's mitigated by the fact what I showed you here earlier. But as I showed you earlier, we're putting in 12,000. But if you go, well, I just can't do 12,000, then what can you do? 4,000. Can you do 10,000? Can you do 8,000? Can you do 4,000? If you can't do, well, can you do, take 1 or 2 years off and go back to 4,000? I mean, it might be we drop the death benefit a little bit. I mean, we can work with that, but when we do the consultations on this, we definitely have to we check your financial situation. If you're in a strong situation, if you got money in the bank, if you got a steady job, and if you're a saver mindset, and you're motivated to save for retirement, and you understand all the different great qualities of Index Universal Life, and you understand that there's going to be quite a bit of cash accumulation over the years that you can dip into, then you're a good candidate. There's a lot of guys out there writing policies at 250 a month. Oh, Victor, I really like this. I want to get started. I can only do $250 a month. How much you have in savings? Well, I got $1,000 in savings. I'm not going to write that person. Someone else might. I'm not going to write them because they're not a good candidate. They got to be a good saver. They got to have. I like to see a good 5,000 to 10,000 in the bank minimum. Myself, most of the most of these that I write, people are sitting on 20, 30, $40,000. Um, they'll maybe part with 10 or 15,000, drop it in there, and then put $12,000 a year. They'll keep the rest on the sidelines later on as things go, and they continue to be, um, say 3 or 4 years down the road, and they say, "Well, Victor, I got $50,000 in there. We'll drop some extra money into the policy or open up a new policy." So I don't have the issue with people down the road not being able to pay into the policy anymore because you want to be the right candidate for one of these. If you don't have but 1,000 and you want to start, in savings, and you want to start with putting $250 a month into a retirement account, then put it into but you really do want an IUL, just put it into a savings account somewhere. Build that rainy day fund to 10 or $15,000. Just keep putting it in there, putting it in there, and then one of these days, and make sure you're not in a whole lot of debt. Okay, we can show you how to get out of debt, but make sure you're not in a whole lot of debt, and then you're a good candidate. And then we can use cash value life insurance to get out of debt. It just depends on your particular situation. But that's the only, drawback as far as if you work with somebody that really knows how to design it. If you work with an insurance company that has reasonable fees, and I showed you some very, very reasonable fees in this policy, and you work with an insurance company and an advisor and an agent that designs it well. The indexes are good. The indexes have outperformed what the policy is illustrating. The policy illustrates 6%, 5.75% is the most they can illustrate. You want to make sure those indexes are doing better than that. So you have a very, very good opportunity to get the illustrated returns or outperform the illustrated returns. That's where you want to be. So if this video has been helpful, has kind of straightened some things out in your mind, and you want to see if you're a good candidate and how well Index Universal Life could work for you, as a strategy for tax-free retirement. Let me know if you like this video. Please like it and share it with other people. Um, and I hope to be working with you soon. This is Victor Cuevas, Victor for Advice.